Look, I need you to pay very close attention to what I'm about to show you, because what's unfolding in the gold market right now is something most people won't see until it's too late. And by then, the opportunity will have already passed them by. You know what's fascinating? Every major wealth transfer in history has been preceded by the same pattern, the same signals, the same institutional behavior. And right now, as I'm recording this, we're seeing those exact same patterns emerge in real time. But here's the thing. Most retail investors, most everyday people, they're completely blind to it. They're watching the wrong indicators, they're listening to the wrong voices, and they're about to miss one of the most significant moves in precious metals we've seen in decades. Let me paint you a picture of what's actually happening behind the scenes. While mainstream financial media has been obsessing over tech stocks and cryptocurrency volatility, something extraordinary has been taking place in the physical gold market. Something that tells a very different story than what you're hearing on CNBC or reading in the Wall Street Journal. Central banks around the world have been accumulating gold at a pace we haven't witnessed since 1967. Think about that date for a moment. 1967. That was 4 years before Nixon closed the gold window. 4 years before the entire global monetary system was fundamentally restructured. And what were central banks doing in the years leading up to that historic moment? They were quietly, methodically, aggressively accumulating physical gold. The People's Bank of China added 225 tons of gold to their reserves in 2023 alone. But here's what makes this truly remarkable. That's just what they're reporting officially. Industry insiders and analysts who track physical flows estimate the actual number could be 3 to 4 times higher. Why? Because China has a long history of accumulating gold through unofficial channels, through state-owned enterprises, through proxy purchases that don't show up in official reserve data until years later. Poland's central bank governor went on record saying they plan to increase their gold reserves to 20% of total reserves. 20%. Let that sink in. This is a NATO country, a Western-aligned nation, publicly stating they're moving away from dollar-denominated assets and into physical gold at a scale that would have been unthinkable just 10 years ago. But it's not just central banks. Look at what's happening in the COMEX warehouses. Eligible gold stocks, that's gold available for delivery, have dropped to levels that should be setting off alarm bells across the financial system. We're talking about a decline of over 40% in the last 18 months. Meanwhile, registered gold, the gold that's actually backing futures contracts, is sitting at multi-year lows. You want to know what that means in practical terms? It means the paper gold market, the derivatives market where most price discovery happens, is becoming increasingly disconnected from the physical market. It means there are far more claims on physical gold than there is actual physical gold available to deliver. It's a powder keg. And all it takes is one major player to stand for delivery, to demand physical settlement instead of cash settlement, and the entire structure could come unraveled. I was talking to a bullion dealer in London last week, someone who's been in this business for 30 years, and he told me something that should concern every gold investor. He said the premiums on physical gold, the amount above spot price that buyers are paying for actual coins and bars, have been steadily climbing for months. Not because of retail demand. Retail demand has actually been relatively subdued. No, these premiums are being driven by institutional buyers, by family offices, by sovereign wealth funds that are quietly accumulating physical metal and willing to pay significant premiums to secure it. Think about what that tells you. When sophisticated institutional players are willing to pay 5, 6, 7% above spot price to get their hands on physical gold, what does that say about their confidence in the paper market? What does that say about their expectations for where this is headed? Now let me take you back to a moment in history that I think provides a crucial parallel to what we're seeing today. It's August 1971. Nixon is about to close the gold window, but most people don't know it yet. In the months leading up to that decision, something interesting was happening. Foreign central banks, particularly France under Charles de Gaulle, had been aggressively redeeming their dollars for gold from the U.S. Treasury. They saw the writing on the wall. They understood that the dollar was overvalued relative to gold, that the United States had printed far more dollars than it had gold to back them, and they wanted out. The U.S. gold reserves were hemorrhaging. In just a few years, America's gold holdings had dropped from over 20,000 tons to under 9,000 tons. The system was breaking. And the people who understood monetary history, who understood the mechanics of the gold standard, they knew what was coming. They positioned themselves accordingly. And when Nixon made that announcement on August 15, 1971, gold went from $35 an ounce to over $800 an ounce within a decade. That's not a typo. A 2,200% increase. But here's what most people miss about that period. The real gains didn't happen immediately after Nixon's announcement. There was actually a period of consolidation, of confusion, where the market tried to figure out what this new monetary reality meant. The explosive move came later, when the implications fully sank in, when inflation started raging, when people realized that fiat currency untethered from gold meant unlimited money printing. We're in a similar moment right now. The implications of what's happening haven't fully registered yet. The market is still trying to process the new reality. But make no mistake, the pieces are moving into position. Look at what's happening with the BRICS nations. Brazil, Russia, India, China, South Africa. They've been talking about creating an alternative to the dollar-dominated financial system for years. But now it's moving beyond talk. They're actively developing mechanisms for bilateral trade settlement that bypass the dollar entirely. They're exploring the creation of a new reserve currency that would be partially backed by gold and other commodities. Russia and China are already settling significant portions of their trade in yuan and rubles. Saudi Arabia, the linchpin of the petrodollar system, has been in discussions with China about pricing oil sales in yuan. Think about what that means. The petrodollar, the arrangement where oil is priced and traded in US dollars, which has been a cornerstone of dollar dominance for 50 years, is being actively challenged. And every time these arrangements move forward, every time another country decides to diversify away from dollar reserves, where do you think that money goes? A portion goes into other currencies, sure, but a significant portion goes into gold. Because gold is the only asset that isn't simultaneously someone else's liability. It's the only asset that every central bank in the world recognizes as money. Here's something else that should be on your radar. The mining supply situation is becoming increasingly problematic. Gold production peaked in 2018 at around 3,300 tons per year. Since then, it's been declining. Not because miners don't want to produce more, they absolutely do, but because the easy gold has already been found. The ore grades are declining. The costs are rising. The time from discovery to production for a new mine is now averaging 15 to 20 years. Meanwhile, demand is accelerating. Industrial demand for gold in electronics, in medical devices, in aerospace applications, it's growing steadily. Jewelry demand in Asia remains robust despite economic headwinds. And then you have investment demand, which is starting to wake up as people begin to recognize the inflation that's been baked into the system. You add it all up, and you have a supply-demand dynamic that's becoming increasingly tight. And in commodities markets, when supply gets tight, prices don't move gradually. They spike, they gap. They move in ways that catch everyone off guard. Let me tell you about something that happened in the silver market in 2011 that I think provides a useful lesson. Silver had been climbing steadily, moving from around $18 an ounce to the mid-30s over the course of several months. Then, in a matter of weeks, it exploded to nearly $50 an ounce. Why? Because a supply squeeze developed. Because industrial users who had been operating on just-in-time inventory suddenly realized they needed to secure physical metal. Because investors piled in, recognizing the momentum. But here's the crucial part. The people who made the most money weren't the ones who bought at $48 trying to catch the last bit of the move. They were the ones who had positioned themselves months earlier, when silver was still in the 20s, when the setup was developing, but before the crowd recognized it. That's where we are with gold right now. The setup is developing. The institutional players are positioning. The supply-demand fundamentals are tightening. But the crowd hasn't recognized it yet. The mainstream narrative is still focused elsewhere. And speaking of positioning yourself properly, quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs actually work. It's linked in the description below. Covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, the custodian selection process, the storage requirements, all of it. Worth checking out if that's relevant to your situation. All right, back to what's happening in the market. So let's talk about price targets, because I know that's what everyone wants to know. Where is this headed? What's realistic? What's possible? Here's how I think about it. Gold is currently trading around $2,000 to $2,100 an ounce, depending on when you're watching this. To understand where it could go, you need to look at it through multiple lenses. First, there's the inflation-adjusted lens. The previous all-time high for gold was $850 in January 1980. If you adjust that for official CPI inflation, you get a number around $3,200 in today's dollars. But here's the thing. Most economists agree that official CPI significantly understates real inflation. If you use the methodology that was used to calculate CPI in 1980, the same methodology before it was repeatedly revised to show lower numbers, that $850 high translates to somewhere between $5,000 and $6,000 in today's dollars. Second, there's the monetary-based lens. Look at how much the money supply has expanded since 2008. M2 money supply has more than doubled. The Federal Reserve's balance sheet has gone from under $1 trillion to over $8 trillion at its peak. If gold were to maintain the same relationship to the monetary base that it had historically, we'd be looking at prices well north of $3,000 an ounce just to reflect the currency debasement that's already occurred. Third, there's the technical analysis lens. Gold has been forming a massive cup and handle pattern on the long-term charts. For those not familiar with technical analysis, a cup and handle is one of the most reliable bullish continuation patterns. It typically resolves with a move that's equal to the depth of the cup. In gold's case, that would project a move to somewhere in the $3,500 to $4,000 range. But here's what I think is most important to understand. These price targets, these projections, they're based on orderly market conditions. They assume a relatively smooth progression higher. What they don't account for is the possibility of a disorderly move, a squeeze, a panic into physical metal that overwhelms the paper market. If we see a scenario where the paper gold market breaks, where the disconnect between paper and physical becomes so extreme that the pricing mechanism itself is called into question, all bets are off. You could see moves that make the 1970s look tame by comparison. And there are several potential catalysts that could trigger exactly that kind of scenario. A major bank failure that calls into question the safety of the financial system. A sovereign debt crisis in a major economy. A geopolitical event that disrupts global trade flows. A loss of confidence in central banks' ability to control inflation. Any of these could be the spark. Look at what happened in March 2023 when Silicon Valley Bank collapsed. Gold spiked $100 in a matter of days. That was just one regional bank. Imagine what happens if we see a systemic crisis, if we see multiple institutions in trouble simultaneously. Or consider the geopolitical landscape. Tensions between the US and China over Taiwan. The ongoing conflict in Ukraine and its implications for European energy security. Instability in the Middle East. Any of these situations could escalate in ways that drive massive safe haven flows into gold. But you don't even need a crisis. You just need a recognition of what's already happening. You need investors to wake up to the fact that real interest rates adjusted for inflation, are deeply negative. You need them to recognize that their purchasing power is being eroded, that the dollars in their bank account are buying less every year, that they need a store of value that can't be printed into existence by central banks. And that recognition is starting to happen. You can see it in the fund flows. You can see it in the premiums on physical metal. You can see it in the accumulation by central banks and institutional players. Here's something that doesn't get talked about enough. The gold market is actually relatively small compared to other financial markets. The total value of all the gold ever mined is around $13 trillion. That sounds like a lot until you compare it to the bond market, which is over $130 trillion, or the stock market, which is over $100 trillion, or the real estate market, which is over $300 trillion. What that means is that it doesn't take massive flows to move the gold price significantly. If just 1% of global financial assets decided to rotate into gold, we're talking about flows that would overwhelm the available supply and send prices exponentially higher. And here's the thing. That kind of rotation has happened before. It happened in the 1970s. It happened in the 2000s. And the conditions that drove those rotations, currency debasement, inflation, geopolitical instability, loss of confidence in the financial system, those conditions exist today in spades. Let me tell you about a conversation I had with a portfolio manager who runs a multi-billion-dollar fund. This is someone who's been in the business for 40 years, who's seen multiple market cycles, who's managed money through the dot-com crash, through the 2008 financial crisis, through every major market event of the last 4 decades. He told me that he's more concerned about the stability of the financial system now than he was in 2008. Why? Because in 2008, central banks had ammunition. They could cut rates from 5% to 0. They could implement quantitative easing, which was a new tool at the time. They could backstop the system with emergency lending facilities. And it worked. They stabilized the system. But now? Interest rates are already at historically low levels. Central bank balance sheets are already bloated. The debt levels, government debt, corporate debt, household debt, are at all-time highs. If we have another crisis, another moment where the system is threatened, what tools do central banks have left? More money printing. That's it. That's the only tool in the box. And what happens when the market realizes that? What happens when investors understand that the response to any future crisis will be more currency debasement, more inflation, more erosion of purchasing power? They rotate into hard assets. They rotate into gold. This portfolio manager told me he's been steadily increasing his gold allocation over the last 2 years. Not because he's a gold bug, not because he has some ideological attachment to precious metals, but because when he runs the scenarios, when he looks at the risk-reward, when he considers the potential outcomes, gold is one of the few assets that make sense. And he's not alone. I'm seeing this across the institutional landscape. Family offices that have never owned gold are starting to allocate 5%, 10%, even 15% of their portfolios to physical metal. Pension funds are increasing their commodity allocations with a heavy emphasis on precious metals. Sovereign wealth funds are diversifying away from traditional financial assets. This is the smart money. This is the money that moves before the crowd. This is the money that positions itself ahead of major trends, not after they're already obvious to everyone. Now, I want to address something that I know some of you are thinking. But gold doesn't pay interest. It doesn't generate cash flow. Why would I own an asset that just sits there? It's a fair question. And the answer is that gold serves a different purpose in a portfolio than stocks or bonds or real estate. Gold is insurance. It's a hedge against the debasement of fiat currency. It's a store of value that maintains purchasing power over long periods of time. Think about it this way. If your house burns down, you don't complain that your fire insurance didn't pay you dividends while you owned it. You're grateful that when disaster struck, you had protection. Gold is the same thing. It's protection against monetary disaster, against currency collapse, against the erosion of purchasing power that comes from unlimited money printing. And here's the thing. That insurance is getting cheaper by the day in real terms. Because while gold has been consolidating, while it's been trading in a range, the money supply has continued to expand. The debt has continued to grow. The imbalances in the system have continued to build. Every day that gold doesn't reflect the true extent of currency debasement is another day that it's undervalued. Another day that it's offering you the opportunity to acquire protection at a discount. Let me give you a specific example of how this plays out. In 2000, you could buy the Dow Jones Industrial Average with about 40 ounces of gold. The Dow was around 11,000, gold was around $280. By 2011, at the peak of the last gold bull market, you could buy the entire Dow with just 6 ounces of gold. The Dow was around 12,000, gold was around $1,900. That's the power of gold during periods of monetary instability. It's not just that gold goes up in nominal terms, it's that gold preserves and increases purchasing power relative to other assets. It maintains your wealth when other assets are being devalued. And we're setting up for another one of those periods right now. The Dow to gold ratio is currently around 20. That's elevated by historical standards. If we see a reversion to the mean, if we see gold reassert itself as the ultimate store of value, that ratio could easily compress back to single digits. Which means either gold goes significantly higher, or stocks go significantly lower, or some combination of both. My bet? We see both. We see gold move higher as investors seek protection from currency debasement, and we see stocks struggle as the reality of slowing growth, persistent inflation, and tightening financial conditions sets in. But here's what's crucial to understand. This isn't about timing the perfect entry point. This isn't about trying to buy at the absolute bottom and sell at the absolute top. This is about recognizing a major trend in its early stages and positioning yourself accordingly. Because the reality is, by the time this move is obvious to everyone, by the time gold is on the front page of every financial publication, by the time your neighbor is talking about buying gold at the barbecue, the easy money will have already been made. The opportunity is now. While the setup is developing, while the institutional players are accumulating, while the supply-demand fundamentals are tightening, while the crowd is still distracted by other narratives. Think about the people who bought gold in 2001, when it was trading at $250 an ounce and everyone said it was a barbarous relic with no place in modern portfolios. They looked crazy for a while. But by 2011, when gold hit $1,900, they looked like geniuses. Or think about the people who bought Bitcoin in 2013, when it was trading at $100 and everyone said it was a scam with no intrinsic value. They endured years of volatility, years of skepticism. But those who held on saw returns that changed their lives. The pattern is always the same. The big moves, the life-changing returns, they come from positioning yourself ahead of major trends, from having the conviction to act when the setup is clear, but the crowd hasn't recognized it yet. And right now, the setup in gold is as clear as I've seen it in my career. The fundamentals are aligned, the technicals are supportive, the institutional behavior is telling, the geopolitical backdrop is conducive. The monetary conditions are perfect. All the pieces are in place. The question is, are you going to act on it? Are you going to position yourself ahead of what's coming? Or are you going to wait until it's obvious to everyone, until the move is already well underway, until you're buying at significantly higher prices? Because here's what I know from decades of watching markets, from studying history, from observing how these cycles play out. The people who make the most money aren't the ones with the most sophisticated analysis. They're not the ones with the most complex models. They're the ones who recognize major trends early and have the courage to act on their convictions. They're the ones who can look at what's happening beneath the surface, who can see the accumulation by smart money, who can connect the dots between central bank policy and currency debasement and the inevitable flight to hard assets. And they position themselves accordingly. So here's my challenge to you. Don't just watch this video and move on with your day. Don't just nod along and think, that's interesting, and then do nothing. Take action. Do your own research. Look at the data I've presented. Verify it for yourself. And if you come to the same conclusions I have, if you see what I see, then position yourself accordingly. Because what's happening in the gold market right now isn't going to wait for you to be ready. It's not going to pause while you deliberate. The institutional players are moving now. The central banks are accumulating now. The supply-demand dynamics are tightening now. And when this move really gets going, when the crowd finally recognizes what's happening, you're going to wish you had acted when you had the chance. When gold was still in the 2000s, when physical metal was still readily available, when the opportunity was staring you right in the face, don't let that be you. Don't be the person who looks back in 2 years, or 5 years, or 10 years, and says, I saw it coming. I knew what was happening, but I didn't act. Be the person who had the courage to position themselves ahead of the crowd, who recognized a major trend in its early stages, who took action when it mattered. The choice is yours. The information is in front of you. The opportunity is here. What you do with it is up to you.